Yo, this is Benji from Stock Hours back with another video. Today we're going to be going over the basics of option contracts. So go ahead and smash that like button to help get this video out to more people so they can help learn about option trading. So to start off, we're going to talk about what is an option contract. So an option contract is an agreement between two parties that facilitate a transaction involving a preset price and date. So options have an expiration date when you buy them. Generally in our chat, we play same week expirations. Buying option preserves the right, but not obligated to purchase or sell the underlying asset. So basically, when you buy an option contract, you're basically buying the right to 100 shares, basically. And they can get executed and all that, and depending if it gets executed in the money or not depends on how that goes down. But we're not going to get into that today. We're going to get into how we use them in our intraday day trading and scalping. It is really important to note that they have the expiration date, so we generally play same week contracts and they expire at Friday at 4 p.m. So as the week goes on, they'll get cheaper and they'll get more volatile. Alright, so and when they get more volatile, basically they will get they will move faster, like they'll be riskier basically. There's two types of option contracts. We have calls and puts. Calls basically are a bet. I don't like to say bet, but it's basically a bet that the stock's going to go up, so you can basically capitalize if the stock's moving upwards. And there's puts, and you can do that. It's basically the exact opposite, so you make money on the stock going to the downside. So you can't be biased in this, and this is one of the reasons I really love doing what I do, because you basically just execute what the market gives you. You're not strictly biased on, this is bullish, I'm only going to play this to the upside or whatever. So, and another thing to understand is stocks take the staircase going up and the elevator going down. So, some of my biggest plays were with puts. Yeah. Alright, so here we have an example of the option chain for Tesla on Interactive Brokers. So I'm going to break down this whole screen for you and try to make it easy. I've set mine up a little differently, with open interest, volume. I have the mark, the spread, and the bid and the ask, and you can see that right here. So with option contracts, we have a strike price. Okay, so this is the strike. It says right here, these are our strike prices right here. So whatever price Tesla is at is going to determine where the middle of this option chain is at. So you can see these are highlighted in the blue and these are highlighted in the gray. So it's basically like a ladder and it moves up and down with the stock price. So if Tesla were to go from 710 to 715, this would shift and these would move down, and you can see the difference in price here. So the 715s are $10.50 here, and that would basically be about $1,050 for this contract. You can see as it moves $5 into the money, we gain about a $300 in value per contract, so about a 30% move there. So you can judge your risk and you can see how these contracts move. When picking the contract, you want to look for the most volume and open interest, okay? And you can see I have these two columns right here. Open interest is the amount of contracts that were swung overnight. So it kind of helps you gauge like what contracts people are looking at. And then we have volume, and that's the amount of contracts people are in. So not only do we need to look at the stock volume for our plays when we're getting in and getting out, we want to use the volume to help us pick our contracts. And that's one of the most frequently asked questions in our chat. We use the volume and open interest. So let's say Tesla was at, 714 or 713 or 711. I think it was at 711 right here in this example. But let's say we were about to play the 715 break. So you could go on here and you could look for the volume and open interest, and then you can see here on the 715s there was 2K that were swung overnight. we have 10K in volume compared to, like, let's say the 720s. I mean, they also have 10K in volume, but I would like to pick the 715s because they're closer to in the money, and we would be able to capitalize on that contract on the premium flip. And that's basically the 715 contracts moving to in the money. So that's how we would do that. In some examples, you'll literally see all these contracts will not have volume, but certain ones. So it's generally the closest whole number. So it's generally the closest whole number here. So it'd be the 715s or the 720s, the 725s, the 730s. On something like Amazon, it's every 50 intervals. Like you can see here on the 71250s, it has 4K in volume compared to the 10K. So like you would definitely want to go with the more liquid contracts. And the more liquidity equals the better spread, which is right here. And that's the difference between the bid and the ask. So when you're buying a contract, you're going to get filled in between this right here, especially if you're buying market. So these have a 30-cent spread, and that's 10.20 between 10.50. It's 30 cents. So that's your spread on those contracts. So as this would get close and we're about to break, you will see the spread get tighter and tighter and tighter. And the tighter the spread, the better, and the better fill and better execution you're going to be able to have on that trade. Also, you want to check for the stock's IV, which is shown up here. Generally, you want a stable IV. I'm going to go over that more so later in the video. Up here, we have our expiration dates. So each one of these is a week, basically. So we have this week, it shows the days remaining. Next week, the days remaining. The week after that, and so on. Alright, so right here we have the option chain on Thinkorswim. So just to go ahead and show you guys, because I know most of you guys are on Thinkorswim. We have the strike prices right here. The expiration dates are little drop downs instead of the tabs. We have the bid and the ask. Here I got the delta, the volume, and open interest. And you can add the mark as well on here by just clicking up here and editing the layout. You cannot have a spread column on Thinkorswim, which is kind of lame. I really do like the spread column. This is my setup on Interactive Brokers and how I trade options, and we have a video on the channel about how we trade options on Interactive Brokers and my whole setup on that, and basically how to use that to your full potential and how to get these custom buttons set up, or you can have a buy limit slippage button and whatnot. And right here I have a level 2 just for the contracts, so I would highly suggest you do that. You can definitely do that on Thinkorswim as well. That way you can see, you know, the real-time bid and the ask very easily, and watch it change, and there'll be walls on the contract on level 2 as well. I also have the spread added up here, so if I'm doing a play like right off open, I can watch that very closely and watch for the spread to readjust and get tighter. And then here I just have my normal level 2. Alright, so we're going to talk about implied volatility. This is the forecast, or the market's forecast on how much the contracts are going to move. If we go back here, you can see it right up here on TOS, and then you can see it right up here on Interactive Brokers. So what we look for with implied volatility, or I'm just going to call it IV, is a stable IV. So basically, I'm just going to use Amazon as an example. A stable IV on Amazon, it's normally around 20%. So you don't want it changing rapidly while you're in a trade. You know, you want it to stay at 20% when you're in that trade for the risk to be low. During earnings and whatnot, you'll see the IV go crazy up, and basically they'll inflate the contract prices, and then it makes Amazon contracts like, you know, 10K a contract sometimes when they're normally 2K. Then at that point it's like not even worth playing. A thing you don't want is IV, like if it's moving while you're in the trade, sometimes IV can drop, and then they'll basically make it where the contracts aren't moving correctly, in your favor as much, and you can really get burned with an IV crush, especially with swinging. If you do a big swing overnight, the stock has earnings. I've seen it with Netflix. It pushed up, fell down, but it opened fairly green, but the contracts just got crushed from the IV, and basically you would have been red regardless if you had calls or puts. So you have to be very careful and watch for that stable IV. All right, next thing is the option Greeks here. So these are the main, or the Greeks here for options, and these basically basically represent how the option contracts change in price. It's not all based on just the stock price, and the stock price in that movement. So there's the Greeks plus the stock price, and that's how you get your option price, and that fluctuates. To start, we have delta. That's the rate of change between an option's price and and per $1 change in the stock's price. So if the delta is 0.4 and the stock moves $1, the contract is going to go up 40 cents. Is basically how you can find that. Basically, you want that to be stable as well. To be honest, with how we do options and our scalping and whatnot, the only Greek you truly have to worry about is theta, and that's the time decay, the rate of change between the option's price and time. So as it gets closer to that expiration date, theta eats away at your contracts. So basically after Wednesday, if you're playing same week contracts, the risk goes up significantly. And on Thursdays and Fridays, I normally size down a little bit to compensate for that. And I mean, I've made more with the smaller size on Friday than I have with my full size normally before. So you can really capitalize on the, like how the contracts get cheaper throughout the week, and they get more volatile as well. So they move quicker. Especially when, there's the time decay, and then they move to in the money and you get that premium flip. So especially when you're swinging and whatnot, you want to have theta in mind. You don't want to sit there and buy and hold throughout the week. If you did that and the stock doesn't even move, you'll literally be red on your position, just solidly because of time decay. The next Greek is gamma. And these you really don't got to worry about as much. This is some good information to know about your craft and what you're doing. So gamma, the rate of change between the options delta and the stock price. This indicates the amount delta would change given a dollar move on the stock. So it's basically influencing delta. We have vega, that represents the rate of change between the options price and the stock's implied volatility, as that implied volatility changes 1%. Then we have RHO, rho, I guess, represents the rate of change between an options price and 1% change in the interest rate. Alright, so I'm going to wrap up the video here with the risk on Friday. This is just a little paragraph I've written up before. But basically, on Fridays, I generally size down. I'm trading with a fourth of my normal position. So if I normally trade with 10,000, I'm trading with 25 to 3K, 2,500 to 3K on a Friday, just to compensate for that risk. You don't want to mess around on Fridays. They can make or break your week. The volatility is so crazy on Friday, given that the contracts expire at 4. So you really got to be careful. Just to start, either trade next week contracts so you're not affected by theta as much, or just generally stay sized down. So I'm going to wrap up the video there, guys. I hope you guys enjoyed this, and thank you for watching.